The last few years have been extremely difficult for listed property companies in South Africa, and 2022 was no different. If we look at the one-year return for the fund versus the benchmark as well as versus the market, you can see there was very little in the way of return at all. The fund was down just under 1%. The market was up just over 0.5%, and the peer group was down 2.5%. I'm going to take a bit of time and look at that in more detail in a future slide. You can also see that over the last 3 years, the returns have also been fairly pedestrian. A lot of people have been talking about the recovery that has happened in the listed property sector, particularly since COVID. Unfortunately, that hasn't quite reflected itself in the numbers yet, but we should start to see an improvement in the 3-year return, not because of what's happening now, but because of the poor returns that we will start to throw out, particularly in March 2020. So by the time we get to March this year, you should see a vast improvement in the 3-year return. Importantly, though, the fund has significantly outperformed both the benchmark and the peer group over that period as well. Clearly, you can see the difficulty that listed property has had over the last 5 years, not just the pandemic, but some of the problems that we face in the South African economy. And similarly, the picture remains fairly weak over the last 7 years. If we focus specifically on the fourth quarter performance, as I mentioned, the fund slightly underperformed both the market and it more than slightly, it significantly underperformed both the market and the peer group in the fourth quarter. And that was simply because market returns were driven by a very, very strong recovery in 3 heavyweights, Growthpoint, Nepi, and Redefine. Those 3 companies had underperformed in the first 3 quarters of the year, but for reasons that are almost unknown to most people, and there's certainly no discernible reason for the strong showing, they did extremely well in that fourth quarter. The smaller and medium-sized SA REITs that make up the majority of the Nedgroup Investments Property Fund actually underperformed the larger caps in that quarter. One of the reasons that some people have given for the strong showing by those larger caps was a renewal of institutional interest in the sector. It certainly didn't have anything to do with the recovery in economic growth or the potential for a recovery in economic growth. Interest rates are rising, so it could only have been as a result of institutional appetite. If we look at that in numbers, if you just look at the performance or the contribution of the performance that Growthpoint, Nepi, and Redefine made, of the 19% total return from the SAPI in that fourth quarter, 13% of the 19% came from just those 3 counters. What I have on the slide are the performance of the on the chart, the performance of the 4 largest companies in the Nedgroup Investments Property Fund. And you can see, even though they had great returns, Depula up over 10%, Storage up over 10%, and both Spear and Fairvest up around 7-8%, they weren't enough to compensate for the strong returns of Growthpoint, which was up 30%. In fact, the best performing REIT in the sector was one that does make up a fair chunk of the Nedgroup Investments Property Fund at just over 5%, and that was Indlu Place, which was up 33%. So you can see there were still very strong returns from a number of companies in that fourth quarter, albeit that the bulk of that return came from those very large cap stocks. If we look at 2022 as a whole, you can see it was a case of 2 halves, not quite 2 halves. There were 3 very difficult quarters at the beginning before that strong surge in the fourth quarter. What is important to look at here is the fact that the Nedgroup Fund exhibited significantly less volatility throughout 2022, and that's something that has been characteristic of this fund right from the very start. It exhibits lower volatility than the market and lower volatility than the peer group. The total return, as I've mentioned already, was just under 1%. But for most investors that were just looking at the price movement, they would have seen that the price was down over 10%. For many, that seems to be the return that they got. However, you need to think about the income return that is also being delivered on this portfolio. So listed property, unlike many other asset classes, has a significant income return component when you think about total returns. So the income return for this portfolio was 10%. Yes, as I mentioned, the prices were down just over 10%, giving you a total return of close on -1%. If we look at the current fund positioning, we still have a significantly overweight position in South Africa. It's one of the big differentiating factors of this portfolio. Just under 80% of the portfolio is exposed to South African property. So most of the businesses that we own invest almost exclusively here in South Africa. That number has been dropping. It was a lot higher. It was closer to 85% a couple of years ago. But a number of the businesses we own, like Equitas and Storage, have been expanding their global footprint, particularly in the UK. The one area where we have a very low exposure, and certainly a lot lower than the market, is in Central and Eastern Europe, where today the market exposure is around 30%, but the fund exposure is still 6.5%. Again, that has also been growing. It was a lot lower than this, but we now are starting to see some value in the likes of Nepi Rockcastle, and so we've slowly been adding to that position on a relative valuation basis. In terms of the property type exposure, we remain significantly underweight retail and specifically large mall exposure. Only 8% of the fund is exposed to large malls, where we anticipate a lot of or further downside in the years ahead. Our exposure that we take to retail is mainly in convenience and neighborhood retail, often in rural areas and townships. We have also an overweight position in residential and self-storage, where the combined exposure of those two property types is just under 18%. Self-storage, we think the fundamentals remain strong. Residential, there's just so much value today in the stocks that we get that residential exposure through. We already saw just how well Indlu placed it in the fourth quarter, so that's a residential REIT. Octodec similarly has been a good performer of late, and we expect that to continue as the residential market recovers, mainly as a result of a lack of affordability for first-time home buyers. When interest rates were very low, it was very easy to buy a home, or certainly easier than it is to buy a new home today when interest rates are substantially higher. In terms of the outlook for 2023, what we did see in the fourth quarter was distribution growth for the market as a whole turning negative. A lot of that had to do with base effects. Companies were paying excess income during 2021 as a result of not paying any income in 2020 during the COVID pandemic. So the base that had been set, certainly in the fourth quarter of 2021, was quite high. However, we are still expecting distributions to remain fairly benign. Distributions for the fund as a whole are expected to decline by between 3 and 5% in 2023, after rising 15% last year. But that is also mainly as a result of structural issues or structural phenomena, and mainly as a result of the corporate action in both Dipula and Fairvest, which are the fund's two biggest positions. The yield on the fund is still well in excess of 10% net of fees. And so a lot of the bad news that we think is likely to come in this year is already embedded in the prices of many of the securities that we own. And we also think that, given what we saw in the fourth quarter, institutional appetite for South African listed property has increased, notwithstanding all of the issues that the sector faces, including higher interest rates, load shedding, and lower global growth. Thank you. The outperformance of the last 3 years is mainly attributable to the different property types that we own, or the weighting of the property types that we own in the Nedgroup Investments Property Fund. The two sectors to have been hit hardest are large malls and offices, and we have a lot less exposure to those two property types than the rest of the market. We think that the fundamentals for those two property types remain under pressure, and our exposure there is still low. As a result of that, we think things like the convenience and neighborhood retail, self-storage, industrial, our Western Cape, overexposure to the Western Cape should continue to benefit the fund, and we should still be able to outperform the market. As I mentioned during the presentation, distributions are falling in 2023 mainly as a result of structural issues, or the fact that you've had this corporate action in both Dipula and Fairvest, where the changing in capital structures or acquisitions that the businesses have done have meant a dilution in distributions for 2023. Those should then be in the base, and we are anticipating distribution growth of around 7% in 2024 based on current forecasts. Yes, we know that things may change between now and the end of the year given some of the headwinds that the sector faces, but we do think that with what the sector has done over the last 3 or 4 years in terms of capital allocation, balance sheet management, property asset management, the sector should be able to grow distributions by between 3 and 6% per annum beyond 2024. Yep. Clearly, stage 6 load shedding is not desirable for the listed property sector. We are already starting to see, particularly in retail properties, the cost of occupation as a percentage of turnover rising from 6, 7, 8, and 9% to levels of 12, 13, 14, and 15%. That's just not sustainable. So at some point, the landlord is going to have to start bearing some of the brunt of this increase in costs associated with load shedding. From an economic growth standpoint, stage 6 load shedding isn't great. And property businesses need economic growth. They need people to be demanding more space, and with stage 6 load shedding, that's not likely to happen. What we have seen, however, over the last 3 to 5 years is a significant investment into renewable energy or solar power by many of the companies that are listed in South Africa. And the returns that the companies enjoy on those particular projects are actually quite high once the installation has been completed. So it usually takes about 2 or 3 years for the returns to start to materialize, and so we should start seeing some of that. So you've obviously got the downside risks of an economic slowdown. You've got higher occupancy costs, but the listed property companies have already been preparing for this. Many of them have already implemented a significant projects associated with providing solar power, and so that should mitigate some of the downside risks. But it is one of the things that we're going to watch closely. It's certainly one of the questions we're going to ask each of the management teams when we chat with them. What is the cost and what is the impact of load shedding likely to be on your portfolio? It's probably early days. We certainly weren't factoring in stage 6 load shedding at the start of the year. It is something now that we have to think about, but it is still early days. But I would say net, it's probably negative for the sector.